So name of the reading is Determination of Forward and Future Prices. It's a fun reading. It's a good mix of theory and numericals, but most of the theory is conceptual. It will provide us an opportunity to dig deeper and understand how futures and forwards are priced and what are the scenarios in which the pricing could be different. Plus, towards the end, we will also get to spend some time on contango, backwardation, normal contango, normal backwardation type of concepts. So this is the agenda. Introduction, so we do some basic learning outcome. I'm skipping through them faster. Let's get on with the first learning outcome. There's nothing fancy in this learning outcome. It basically says that there could be different category of assets altogether. So think of commodities. So maybe within commodities, let us think of steel. So steel is typically considered as a consumption asset because manufacturing organizations need steel as a input. Think of copper. Copper is also used, it has a manufacturing application, therefore it is a consumption asset. But think of equities. Do we consume equities? So equities are typically considered as investment assets. Think of bonds. Again, we don't consume bonds, so bonds are considered as investment assets. So here in this learning outcome, they want you to build perspective that there are different assets with different perspectives. Now there is a lot of controversy and discussion about where to put gold, because gold typically falls into both the categories. Gold is used for consumption, but gold is also seen as investment. So different authors have different opinion, but a lot of authors feel that keep gold as a third category all by itself. You can keep it in the third category. Then even livestock is something that we can put into this segment, or most of the agri-related commodities we can again put into consumption segment. Are you fine with this? So if you are given a set of assets, you should be able to distinguish which ones are investment and which ones are consumption assets. Is it fine? So an investment asset is an asset that is held for the purpose of investing, and consumption is an asset that is held for the purpose of consumption. Moving on to next learning outcome now. So this is something that you might want to write. So give heading as short selling of a dividend paying stock. Short selling of a dividend paying stock. Short selling of a dividend paying stock. So first I would cover the background of this concept, and then we will also look at some of the empirical research on short selling. So let us say we have an investor. He's identified two stocks, stock A and stock B. The current price of stock A is 100 and current price of stock A, B is also 100. Then what is his intrinsic value according to the investor? So intrinsic value is what investor feels is the truly justified value of that stock. So investor feels that stock A is worth 150 and stock B is worth 40. So to profit from his outlook, to profit from this opinion on stock A, he will want to take long position. And what is a long position? He will buy at 100 and then he will sell at 150 and then he will expect to earn 50 out of this. But if he wants to profit from his outlook on stock B, he will have to enter into a short sell strategy. So you would enter into a short sell strategy essentially when you are bearish on a stock. So here he will invert the process. He will sell first at 100 and then he will buy at 40. So you sell at 100, you buy at 40, and then you would be able to earn profit of 60. But then the question is that how can you sell a stock which you are not in possession of? Right? So if you do not have the stock, how will you sell this? So the way this process works in US, I'm going to exaggerate a little bit to simplify. So this is an investor. What investor will do is he will go to his broker and he will request him to lend him a stock. Lend, or he will simply, let me write it this way, he will simply borrow one stock. So once he borrows that stock, he will take that stock and he will sell that at the price of 100. Now after a few days, the value of the stock became 40. So at 40, now what your investor will do is he will buy at 40. Then he will take the stock and he will simply return back to the broker. So this is a classic way in which this short sell transaction is structured. You borrow from the broker, then you sell in the market, and then after some days you buy it back, which we typically call as short covering, and then you give it back to the broker. But of course, when your broker gave you a stock, in a way he gave you a loan of that amount, which was 100. So on that you will also be required to pay him some amount of interest. So you would pay some 1%, 50 basis point, whatever the predetermined amount, that amount of interest is also what you would be required to pay. Now what happens is, what if in this period the stock paid a dividend of 10 per share? So when you return back that stock to the broker will say that if I would have been in possession of the stock, I would have been eligible to receive this dividend. I had just lent you the stock, not sold you. That means the true ownership of the dividend is still mine. So if the stock pays dividend in this period, then to the broker, you will also have to reimburse the dividend, which would be of 10. Have you understood this mechanism? So now you can write this down. Are we done here? Have you understood any questions you want to ask? What if his assumption is wrong? Then he will make losses. So question that is being asked, what if the assumption about the opinion about the stock goes wrong? Then he would end up buying the stock maybe at a price of 150, 160, 170. Then he will book losses. So it's like long. You buy hoping that price will go up, but the price can always go down. So in the same fashion, in short, you sell hoping that prices will go down, but it can always go up. So technically, to be honest, okay, so what question Animesh has asked, in short, when the dividend is paid out, it's a loss to the investor. So answer is no, it is not. Because what happens is that when the dividend is paid, value of the stock reduces by dividend. For example, if nothing was to be changed, after the dividend, automatically a stock which was worth 100 will become 90, at least in theory. So therefore, he sold at 100, stock became 90. So he will take that 90 stock, give it to the broker and also give 10. So that dividend is technically not a loss. He is just reimbursing the loss in the value of the stock. Alright, so question I have been asked, if he takes both the position long and short, then the broker will be very happy. Because broker will make brokerage four times, buy, sell, buy, sell. And otherwise, your exposure to the stock would be 0. Should be good? This example is for equity position, not for futures, not for forwards. This is for underlying equity position. Any questions here? Okay. So it was a fairly straightforward learning outcome. Short sell are orders to sell securities that seller does not own. This word you might want to write down. Short squeeze. Short squeeze. If broker runs out of securities to borrow. Okay, so what happens in a real world scenario is that even broker borrows those securities. So there are SLB schemes, securities lending and borrowing. So broker borrows them and then he lends you. So if broker himself is not able to borrow, then that scenario would be considered as short squeeze. So forward and future contracts and relationship between forward and spot prices. So we have done this part multiple times, but this time I'm going to be a little more in depth. So what we know is that forward price is going to be spot price into 1 plus whatever is the interest rate raised to n. Or if we were to use a continuously compounded mechanism, then it would be spot into e raised to RT. But what if we have a spot with known dividends? What if we have a spot with known dividends? That means that underlying equity is going to pay you dividend in that period. Then your formula would be like this: forward is equal to spot minus present value of dividend into 1 plus RFR raised to n, or spot into 1 plus RFR raised to n minus future value of dividend, or spot into e raised to r minus dividend yield adjusted for t, which is a continuously compounded formula. So quickly write down the formulas. We'll do a couple of examples. After the examples, you would not be required to remember the formula. It will come to you logically. E raised to the power r minus dividend yield adjusted for t multiplied by t. These are known dividends. Okay, so let's do an example. Are you done with the formulas? This is going to be a big one. It will take us about 10 odd minutes. In the first section, I am going to do pricing of the forward. And here I am going to do valuation of the same forward. Okay, so there is a difference between pricing and valuation. Pricing means to find out a no arbitrage forward price, and valuation means once you know the price and if the spot changes, then what is the profit or loss that you've made. So valuation is finding out profit or loss. So let us say we have a spot price right now of 100. Then we have expected dividend in 3 months, of 20, and in 6 months to be of 20. So we are expecting 2 dividends, one in 3 months, one in 6 months. Risk-free rate of return is 10%. We want to price this particular forward. Now there would be 2 ways in which we would be achieving this. So first, this is time 0. This is 3 months. This is 6 months. Right now your price is 100. After 3 months is going to be 20. After 6 months is going to be 20. Step number 1, we will discount twist 20 backwards here for 3 months. Then we will discount this 20 backwards here for 6 months. Then we will take a net amount. And then this net amount we will compound forwards for 1 year. That would be your no arbitrage forward price. Let's check if that works. 20 is second clear TVM, 20 is future value, 10 is IY, 0.25 is N. Why 0.25? 1/4. So 0.25 is N. Compute present value. 19.52. Not to lose decimals, I want you to let that number be negative and put that into your first memory slot so that we can get a precise answer. Let it remain negative, put that into first memory slot. Now just say 0.5 is n, 0.5 is n, compute present value, 19.06. Let that number negative and put that into second memory slot. And what we want to do now, we want to say 100 minus the two numbers. So on your calculator you would say 100 plus RCL1 plus RCL2, because anyways those are negative numbers. So that's coming out to be 61.40. Right, so 100 minus 19.5 minus 19.06, that's coming out to be 61.40. Now, is that number on your screen right now? Let it remain on the screen, say second clear TVM. Then make that number as future value. Make the same second clear TVM again. Make the same number as present value. Keep 1 as n, 10 as IY. Compute future value. 67.54. So this 67.54 is your no arbitrage future price with known dividends, or forward price with known dividends. Easy? So this is the first formula that I gave you, where I said S minus PVD, S minus present value of dividend, and then the net amount we took future value for 1 year. Let's look at an alternative method. So I'm doing this in the alternative fashion here. So here again we have one dividend in 3 months, one dividend in 6 months. Right now your price is 100, this is 20 and this is 20. Now what you'll do is you will take this 100 forwards. So you will take this 100 forwards for 1 year. So then you will take this 20 forwards for 6 months, 20 forward for 0.75 years. But this would be a negative value, this would be a negative value, but this would be a positive value. That means that dividend is still to be reduced. Let's check if that works. Second, we don't have to do second clear TVM. So 100 future value anyways is going to be 110. Do you agree? 100 taken forward for 1 year is 110. Let's do this for this 20. Second clear TVM, 20 is present value, 20 is present value, 0.75 is n. So that's now remaining 3/4 of the year, 0.75 is n, 10 is IY, compute future value. So that's 21.48, 21.48. So make that number negative and put that into your first memory slot. Let's overwrite the earlier ones. Then just say 0.5 as n, compute future value, 20.97. Let this number negative, put that into second memory slot. And now say 110 plus RCL1 plus RCL2, which actually means 110 minus 21.48 minus 20.97. 67.54. So if you observe, both the methods would precisely get us the same answer. Is that easy? So I'll give you 30 seconds in case if you want to write. Please write fast. And okay, so I'm explaining the logic. Do you want to know the logic of this formula? जानना है क्या? ठीक. So I'm deriving the formula here. So think of our classic no arbitrage cash and carry derivation that we did. Let us say RFR is 100. So sorry. Let us say spot price is 100. RFR is 10%. And expected dividend expected dividend is 50 in 6 months. Okay, now let us say that a no arbitrage forward price by mistake is being quoted as 110. That means anyone who calculated this 110, he's definitely forgotten to consider the expected dividend. Now see how can we exploit this arbitrage condition. So I'm dividing this into 3 parts. What will you do today? So step number 1, you will borrow 100 from the bank. At what rate? At the rate of 10%. Step number 2, using this borrowed 100, you will buy the stock. And step number 3, you will enter into a short forward. That means you will enter into a short side forward. That short side forward will allow you to sell the stock at 110 after 1 year. What will happen after 6 months? After 6 months, step number 1, you will receive 50. Step number 2, this 50 will be deposited at the rate of 10% for 6 months. Make sense? What will happen after 1 year? After 1 year, you will sell stock at 110 because you anyways have a forward to sell. Then step number 2, you will pay to the bank how much? 110. So your liability is taken care of. And then you will keep for yourself roughly 52.5 approximately. It will be slightly less than that, but you would keep for yourself, precise is 52.44, because bank will pay us interest as 10% for 6 months. So that this is your 52.54 is your arbitrage. Now if this arbitrage was to be avoided, we can easily achieve that if the forward price was to be quoted as 110 minus 52.44. So if this price is quoted as 110 minus 52.44, what is the forward price now? How much? No, not 47. 47? 47.57. It should be 57 because that's 110. So imagine if this was 57.56. If this was 57.56, then 52.44 will come here and we will have to use both the amount to pay to the bank, and then it would be zero profit, zero loss scenario. But if the dividend is not considered, then it opens up arbitrage opportunities. Therefore, that forward price has to effect for the dividend. If you think this is a little difficult to understand, the easiest way to think, when you pay dividend, value of the stock reduces. And therefore, the forward price should factor in the fact that value of the stock is going to be reduced by the amount of dividend. This is still, in case of dividend, the question Sanchit is asked, can we not use spot plus cost minus benefit? That's what we're precisely doing here. We're saying spot plus interest cost minus dividend, which is the benefit. Have you understood the derivation? Yes, no, maybe. Yes. So please write down then. Yes, are we done? So let's get back to the valuation part. Valuation part of the same question. So now please observe carefully. This is where it's a little difficult to solve. After 1 month, same question. After 1 month, spot price is 140. After 1 month, spot price is 140. Now we have to find out the profit or loss to the long. So prima facie, without even touching our calculator, we can easily say that it is a profit or loss. Profit for the long, because the value of underlying has increased. Now how to calculate that profit? The regular method, then I'll give you a shortcut as well. But let's do the regular method here. So this is 3 months, of course not scaled, 6 months. This is where we are right now, 1 month. Now what has happened is that value of your forward, the value of the spot price has become 140. The dividend is still there, we still have a dividend of 20. What you need to do now is to find out a revised forward price. Correct? With the same logic, but this time if you decide to use the present value method, this 20 will take present value for 2 months, which would be 2 divided by 12, and this 20 will take present value for 5 months, and then you will take future value for 11 months. Are you following this with the precisely same intuition? So tell me, what is the new forward price? Quote me the new forward price. 110 point. Have you all received 110.3? Do you want me to help you solve this? Okay, I'm going to do it quickly. Please, let's do it fast. Second clear TVM, 20 future value, 2 divided by 12. 2 divided by 12 equal to n. 10 as IY. Compute present value. So whatever that number is, it must be a negative number on your screen. Put that into first memory slot, STO1. Have you understood what we did? Now just say 5 divided by 12 as n. 5 divided by 12 as n. Compute present value. Let that number also remain negative. Put that into second memory slot. Is it done? Now 140 plus RCL1 plus RCL2. So when we are saying plus, we are actually reducing them because you have a negative memory now. So how much is that coming to net value? 101.09. Now let that number remain on the screen. Then say second clear TVM. Make this 101, whatever number you have, make that as present value. 11 divided by 12 equal to is n. 10 is IY. Compute future value. Have we got 110.3? Okay. Now the most important part. Now listen to me carefully. We have already entered into a forward contract on the long side. Correct? Long side means we have a right and obligation to buy. Now we call up the dealer with whom we purchase the contract. We just give him a casual call and we ask him for the same asset for the remaining maturity, what is the new forward price? So what dealer will do is he will use the same formula and he will quickly calculate and tell you that now the forward price is 110.3. So you immediately tell him, okay fine, please enter into short side for me. That means on the new forward, now you are entering into the short side. So earlier you have a right to buy, now you have a right to sell. So on the date of expiry, no matter what, you will buy at 67.54 and you will sell at 110.3. So the difference of these two, is that going to be your profit? So you are booking your profit here, and how much is that? 42 point. So your profit 11 months from now is going to be 42.76. But we want to know what is the value of that profit today, not 11 months from now. So we can always take present value of that profit for 11 months. So second clear TVM, second clear TVM, 42.76 future value, 11 divided by 12, 11 divided by 12 equal to is N, 10 is IY, compute present value. So 39.18 is the value of that future contract or forward contract. Have you written this? Now I'll show you a little magic. If you see this question on the, please listen to me carefully. If you see this question on the exam, then you would not solve it this way because you'd end up spending a lot of time. So I'm giving you a shortcut. You're really going to like this. If the question says calculate value at time 0, what was the value of stock? 100. Today value is how much? In 1 month? 140. In 3 months, how much dividend? 20. 6 months? 20. We have already entered into a forward at what rate? 67.54. The question is asking us to find out what is the value of the forward. So do one thing, take this 100 forwards for 1 month. Let's do it together. Second clear TVM, 100 present value, 1 divided by 12 equal to is N, 10 is IY, compute future value, 100.79, and find out the difference between 140 and 100.79. 39.2021. And how much was the answer previous case? 39.18. So we lost decimals, but in this fashion you can just get answer in fraction of seconds. And how is this for shortcut derived? If you build an equation for the previous example, if you just put that into form of mathematical equation, and if you simplify, you actually get this. So that way you can solve this substantially faster. I understood what you're saying. We are not taking short, that we are trying to calculate value of the forward. Value means how much profit. So if the dealer decided, or if the trader decided he wants to book his profit, to book his profit he will take the short side. If he takes the short side, then on the rate of expiry he will earn whatever profit we calculated, and then present value of that profit would be 39.20. So what the dealers will actually do is they will create a hypothetical scenario like this. Then they will understand, fine, the present value of profit is 39.20. They will do a cash settlement and close the contract. So that taking the short side is hypothetical, just to figure out how much profit will we actually make. Okay, so what he's saying is that before the dividend, before the ex-dividend date, the stock price might go up. So it might or it might not necessarily. So that is a result of market fluctuation. Whether the stock price goes up, goes down, what are the sentiments attached to the stock. So yeah, what you're saying is that looking at the trend, it seems that stock price will increase more. So not for the exam purpose. Do you want to practice more, or should we go ahead with the next concept? So I think I'll move on to the next concept. So in case if you thought that this was a little difficult, just look at this part of the video more carefully. So that way you would get comfortable. Plus in the learning management system, after every reading you would see additional videos. So in additional videos we are putting in multiple questions for practice. A lot of questions that we did in the class in the previous session. So you can also go through them to build stronger concept on them. I'm moving forward now. I think I missed on one example. We also need to do that. Okay, spot is 1000. Risk-free rate of return is 7%, continuously compounded. And dividend yield is 2%, continuously compounded. Expiry is 197 days from today, you have to find out no arbitrage forward price. Okay, so similar question. I'm going to solve this one for you. What you would simply do is you would say 1000 into e raised to 7% minus 2%, which is your benefit, adjusted for 197 divided by 365, and that's your no arbitrage forward price. How much is that coming to? 1027.35. So no arbitrage forward price 1027.35. Is this part okay? Straightforward. Now, are we okay with this? I think we also did something similar in the previous session. Yes, no, we've done this. Now look at the valuation here. The valuation part is a bit tricky. Let us say after 20 days, spot price has become 850. Spot price has become 850. Now we have to find out profit or loss to the long. In this case, Animesh, what is it? Profit or loss? Is it a profit or loss now? Now this is a loss. So now see how you would do this. A lot of people generally struggle at this calculation, so please observe carefully. So this is day 0, this is day 20, and this is day 197. Right now your price is 850. Now with this 850 we will find out a new no arbitrage forward price, which would be 850 into e raised to 7% minus 2% into 177 divided by 365. So that's no arbitrage forward price. How much is that? How much is the new price? 870.86. 870.86. And how much was the price previously? 1027.35. Now you have a long position here. To book your hypothetical profits, you will have to take opposite side. So you will have a short position here. In this case, you would be booking your losses, not profit. So your loss here is the difference of these two values, which is 156.48. Now to find out present value of this loss, and this is the trickiest part of this question, you need to take this backwards. You need to take this backwards for how many days? 177 days. So you need to take this backward for 177 days. But when you take this backward, and that's where you might end up making a mistake. Now you do not do that at 5%, because now this is not a dividend yield anymore. It's just a simple present value computation. So this you have to do at 7%. If you do this netting at 5%, you would get a wrong answer, and that wrong answer most probably would be one of the options on the exam. So this you need to be careful. This you would take backwards at 7%. So your final answer is 156.48 into e raised to minus 7% into 177 divided by 365, which is 151.27 negative. So 151.27 negative is the value of this contract. So depending on what is the convention we are using. Convention. So there are three conventions: actual by actual, actual by 360, 30 by 360. So here if nothing is mentioned, typically in case of equities and derivatives, generally nothing would be mentioned. So use 365. And if they mention, then use a specific convention. relationship between forwards and future prices. Relationship between forward and future prices. Okay, so the easiest way to think of this is that we have an underlying asset. Let's say the underlying asset is priced at 1000. So there is a 6-month forward available and there is a 6-month future available. So will there be a difference in the prices of this forward and future? And as an investor or as a trader or as a hedger or as a speculator, what should be my preference? Should I prefer to enter into forwards or should I prefer to enter into futures? That's what this learning outcome is about. Are you following this? So there are multiple variables that affect this relationship, but one of the important variable is correlation between asset price and interest rate. So one of the important determinant to decide whether we should have a preference for forward or future would be based on what is the correlation between asset price and interest rate. So right now I'm going to think from the perspective of long. I'm thinking from the perspective of long and I'm assuming that correlation is positive. I'm assuming that correlation is positive. So what is the meaning of correlation is positive? When the value of asset goes up, that is the time when interest rate will go up. Now, if you are in futures, what will happen? If you are in futures and if the valuation of asset goes up, then tell me, we will get to withdraw margin. Do you agree? We have a long position, that value of asset has gone up, so we will get to withdraw the margin. And if interest rate has gone up, we will invest that excess amount at higher rate. Make sense? So whatever that excess amount that is left with us, we will get to invest at a higher rate. Now if asset price goes down and interest rate also goes down, because again the correlation is positive. Again we are in futures. So now this time we will have to deposit margin. But because interest rate is lower, we will get to borrow at a lower or cheaper rate. And in both the cases we can clearly see that futures have a benefit and therefore preference would be for futures contract. Have you understood the intuition? So from a long perspective, if the correlation is positive, future kind of you enter into a win-win situation. When the price go up, you get to invest at a higher rate. When the price go down, you get to borrow at a lower rate. Let us look at the scenario. When correlation is negative. When correlation is negative. So when correlation is negative, when the asset prices are up, interest rate are down, and when the asset prices are down, interest rate would be up. Do you agree with this? So now asset prices are going up. Can I say we can withdraw margin? Can we withdraw margin from here? But we will get to invest at lower rate. We will get to invest at lower rate. But if asset prices go down, then we will have to deposit margin. And this margin we will have to borrow at higher rate. Borrow at higher rate. and therefore in this case you will not have a preference for futures. Now you will have a preference for forwards. Okay, so in forwards we don't have to worry about margins at all. So in forwards we don't have to deposit, there is no mark to mark process, so there is no margin. So therefore preference would be forwards, because in futures anyways it's working against you. When you're borrowing expensive. When you're investing cheaper. So now I'm building a summary table. So with these two tables, it just gives you a thought process of how to think. But this is a summary. This is what you need to know. So when the correlation is, just observe the layout of the table. Correlation is positive. When the correlation is negative. When you are on long side and the correlation is positive, your preference would be for futures. But if the correlation is negative, then your preference would be forwards. But when you're on the short side, it actually works the other way around. So when you're on short side, here the preference would be for forwards, and here the preference would be for futures. And if I were you, I would not remember them. Try to build into logic the way we derive this. So now I'm going to help you think on this. Okay, try to think of this side. If asset price go up, or in fact if asset price goes down, then do we withdraw or borrow? If you are short on future, if asset price goes down, do we withdraw or borrow? Now we withdraw, because it's a profit. But when asset price has gone down, because of negative correlation, interest rate will go up. So now we will get to invest at a higher rate, and vice versa. Therefore preference is for futures. Are you done writing this table? So again, what we are trying to do in this learning outcome, we are trying to decide that as a trader or hedger, what should be the preference, forwards or futures. So one of the key variable that we looked at is correlation between asset price and interest rate. But apart from this, there would be other factors that you might want to consider. One factor is that how much customization are you expecting? So customization versus standardization. Right, so maybe you have a unique case, you want to purchase certain agricultural commodity and you want that delivered to your place, so you need a lot of customization, you will have a preference for forward. But if you're okay with standardized format, then you would have a preference for futures. What you would also consider is transaction cost. So we know that typically forwards are more expensive to enter and futures are relatively cheaper to enter. What you'll also consider, maybe today most important criteria, is the default risk. Especially with so much of supervision and so many banking norms, every firm is now vigilant about what is the open exposure to credit risk, and therefore one of the important factors they would like to consider is by entering into forward, they are exposing themselves to a lot of counterparty risk. So based on these facts, a firm will decide whether forwards are appropriate or futures. Transaction cost in case of forwards is expensive, in case of futures is cheaper. Right? Because in forward we have a dealer, whereas in future we will have a broker, which is through an exchange. Are we doing okay? Fine, so let's stop for a break. So we've covered relationship between forwards and futures. Next heading in the notes. Interest rate parity. Interest rate parity. Interest rate parity. So let us say this is Nimish, who is this? He says it's me, and he's right. So this is Animesh. Now Animesh is kind of very curious. He has a lot of questions, and one of the things that he's observed recently, he's observed that in India, the interest rates are, I'm just rounding off, are 10%, but in US the interest rates are 2%. Let us say current exchange rate is rupees 50 for a dollar. I'm just rounding off the number so it's easier to calculate. So Animesh gets an idea. Idea is that he will go to US and take a loan of 2 million US dollars. So right now just say 2. So he'll go and take a loan of 2. This loan would come at what cost? At the rate of 2%. Then he will convert that amount. At the exchange rate of rupees 50 for a dollar. So after converting that to Indian rupees, how much will he get in rupees term? He will get 100. Then he will invest those Indian rupees in an Indian bank at what rate? At 10%. So after 1 year, how many rupees will he have? He will have 110. Then what he will try to do is, he will try to convert those 110 back to US dollar. But this is where he realizes it's a problem, that he does not know what is the rate at which he will be able to convert. So let's say he goes to a banker, and he's asking the banker that if I want to convert 110 rupees 1 year down the line to US dollar, what is the rate that you would quote me? Quote me a forward rate today. So the banker is kind of suspicious. He understands what Animesh is trying to do. So he also performs some calculation, and I want you to do them for me. Can you please calculate 110 divided by 2.04? 110 divided by 2.04? 53.92. So banker will say fine, the rate is 53.92 for a dollar. So Animesh says okay. Then he tries to convert 110 rupees to US dollar at the rate of 53.92. How many US dollars will he get? He will get 2.04. And how much does he have to pay to the bank? 2.04. And how much is he left with? 0. So which means the whole exercise resulted in no profits but just the transaction cost. But this is teaching us a very important concept here, that this future forward rate of the currency is actually a logical number. It is not any random number. And this forward rate we calculated using the mechanism of interest rate parity. So what is the formula here? The formula is forward rate is equal to spot rate into 1 plus interest rate divided by 1 plus interest rate raised to n. But then which rate to use in the numerator, which rate to use in denominator? So you look at how the currency is quoted. The currency is quoted as rupees for a dollar. So the currency that we have in the numerator, that currency's interest rate we will use in numerator. And the currency that we have in denominator, that currency's interest rate we will use in denominator. Are you following this? This mechanism is called interest rate parity. Let's see if that works. So in this example, 50 into which interest rate in numerator? 10%. So 1.1 divided by 1.02, and that would get us the answer of 53.92. Any questions you want to ask here? So forward rate is equal to spot rate into 1 plus interest rate divided by 1 plus interest rate. The interest rate in the numerator should be of currency in the numerator. Interest rate in the denominator should be of currency in the denominator. Spot into the differential of interest rate, yes. That is your forward rate. Instead of saying into, we should say spot adjusted for differential of forward interest rate should be the forward rate.